If you're a small business owner and you're looking to reduce your tax bill, you've probably found the right video. Today, I'll discuss 10 really straightforward strategies that can help you keep more of your hard-earned money. Firstly, let's talk about how you can save on your tax bill by claiming vehicle expenses. Whether you drive for business or just make the occasional trip for work, there are two ways to claim your costs if you own your own vehicle and use it in the business. And a good pro tip is you can't switch between these methods for the same vehicle, so choose wisely when you first start claiming. Option 1 is the simplified mileage rate. Now, this is the quick and easy method. HMRC lets you claim a set amount for every mile you drive for business, and you can claim 45p per mile for the first 10,000 miles in a tax year, and then 25p per mile after that. Now, this rate covers everything: fuel, insurance, maintenance, even the wear and tear on your car. And it's simple. Just keep a record of your business mileage and you're good to go. You can use a spreadsheet or even an app. There are a few out there, for example, MileIQ is one of them. You may be using this already, but not claiming enough or including all of your journeys. If you average, for example, just 193 miles per week on behalf of your business, that's a $4,500 per year expense, which is tax-free for you to take out and cover your car costs. And it's also tax deductible for your business, saving almost £1,000 in tax. Option 2 is actual costs. If you have higher running costs for your vehicle, this method could save you more. Here's how claiming actual costs works. So firstly, you add up all of your vehicle expenses: fuel, insurance, repairs, road tax, even an allowance against the cost of the car. And then you calculate the business use percentage. For example, if your mileage is for work, you can claim, if it's half of your mileage, 50% of the total costs. And that's not just for petrol, by the way. That's for everything. This method requires more paperwork, but if you drive a lot for business, it can lead to much bigger savings. So, which is better? If you want some simplicity, go with the mileage rate. If your vehicle costs are quite high, the actual cost method may be better for you. The second way you can reduce your tax bill is by claiming home expenses if you run your business from home, and that's even if you're renting. Now, there are two ways that you can do this. Option 1 is a simplified flat rate. Now, this is the easy way. HMRC lets you claim a flat monthly amount based on how many hours you work from home. So, for example, if you work from home 25 to 50 hours a month, you can claim £10 per month. If you work from home 51 to 100 hours per month, then it's £18 per month. And if it's over 101 hours, then you can claim £26 per month. It's simple. There's no need to keep receipts for your bills, but it only covers basics like heating and electricity. Things like internet, phone bills can still be claimed separately. Option 2 is the actual costs method. This is for those who are or can be organised with receipts. So if you're not like Bernard there, the actual costs method could save you more. Here you work out the exact cost of your home used for business. That includes a share of your rent, your mortgage interest, council tax, utilities, and even insurance. You'll need to calculate the proportion of your home used for work, maybe 1 room out of 5, for example. Don't include kitchens and bathrooms in those rooms. And also how much of the time it's used for business. It's a bit more effort, but worth it if your home office expenses are high. So which is better? The flat rate is great for simplicity, but actual costs might be better if you want to maximise savings. Either way, keeping good records is definitely the key. And remember, claiming these expenses can make a real difference in reducing your tax bill. Next up, at number 3, is what's called capital allowances. Now, these let you claim tax relief on assets you use in your business, like tools, machinery, office furniture, or even vehicles. For most purchases, you can use the Annual Investment Allowance, or AIA for short, which lets you deduct the full cost of qualifying items in the year you buy them, up to £1 million worth. For other items, like cars, you'll claim a percentage each year using writing down allowances. Electric cars, though, even qualify for 100% relief in the first year. The key is to keep records of what you've bought and check which category each item falls into, or get a good accountant to help you. Here's a quick win for reducing your tax bill at number 4, paying into a pension scheme. Not only are you saving for your future, but you're also getting tax relief on contributions. If you're a basic rate taxpayer, for every £80 you pay into your pension, HMRC tops it up by £20. That's free money. Higher and additional rate taxpayers can claim even more through their self-assessment tax return. And if you're a business owner, paying into a pension through your company can reduce your corporation tax bill, as long as the contributions are wholly and exclusively for business purposes. The key is to plan your contributions to make the most of your allowances. So this year, for example, you can put up to £60,000 into your pension and still get tax relief. More if you've got unused allowances from previous years. The 5th way you can reduce tax is very smart indeed, employing family members in your business. Now, this isn't just a tax-saving hack, it's a legitimate way to involve your family as long as you follow the rules. Employing your brother-in-law to mop your floors at 100 grand per year is probably pushing the limit somewhat. To claim the costs as a business expense, their role must be genuine and the pay must be reasonable for the work they do, just like hiring anybody else. For example, they could, or even already do, help with admin, marketing, managing your social media. There's a whole variety of different things they can be doing, and probably already are. You'll also need to follow all the usual employer responsibilities, like registering with HMRC, issuing pay slips, and making tax and national insurance deductions. Done properly, their salary is a deductible expense for your business, and if they're on a low income, they might even pay little to no tax themselves. The next and 6th way is by ensuring you're maximising the allowable business expenses. Allowable expenses are costs you've incurred wholly and exclusively for your business, and claiming them reduces your taxable profit. And this includes things like office supplies, travel costs, professional fees, even your mobile phone if you use it for business. Don't forget smaller items that add up, like software subscriptions, bank charges, or protective clothing. And then there's potentially Christmas parties, trivial benefits. The key is to keep accurate records of your spending, receipts, invoices, even a mileage log for travel. This ensures you claim everything you're entitled to, and it's all HMRC compliant. Now, here's a quick fire list of 20 commonly missed allowable business expenses. So number 1, stationery and postage, including ink cartridges. Don't forget your printer and what you're putting in there. Number 2, business software subscriptions, Xero, QuickBooks, Canva, Photoshop, MyIQ, just to name a few. Number 3, hardware and software used in the business, including previously purchased items that are now used by your business. Number 4, mobile phone costs. Ideally, get a contract in the business name as soon as possible. Number 5, uniform and personal protective items, depending on what you do. For example, safety boots for trades, walking boots for dog walkers, overalls for painters, and consider adding your business name through labels or printing your work clothes to turn them into uniform. Number 6, cleaning and valeting for business use vehicles. Number 7, parking fines, but obviously not fines. Number 8, public transport costs, but not commuting. Number 9, accountancy fees. Number 10, legal fees for contracts or debt collection. Number 11, website hosting or domain fees. Number 12, advertising costs, including paid social media campaigns. Number 13 is courses or seminars to improve skills directly related to the business. Number 14, industry-specific subscriptions or trade association memberships. 15, employer or subcontractor training. 16 is recruitment or advertising costs. 17 is public liability or professional indemnity insurance. 18, business contents insurance. 19, bank charges for business accounts. And number 20, finally, small gifts to clients up to £50 per person per year, with some restrictions. Number 7, did you know that choosing the right business structure can have a huge impact on your tax bill? If you're a sole trader, your profits are taxed as personal income, which can push you into higher tax brackets as your business grows. If you operate as a limited company, however, you'll pay corporation tax on your profits, and you can pay yourself through a mix of salary and dividends, which is often more tax efficient. Dividends are basically a portion of the profits you can take as a shareholder or owner of the company, and they're taxed at a lower rate than salary or self-employed income. For example, basic rate dividend tax is 8.75%. For more on how to choose between sole trader and limited companies correctly, check out this video. The key is to align your structure with your financial goals and tax planning. Get this right and you could save thousands in taxes while protecting your personal assets as well. Number 8 is R&D tax credits. Research and development tax credits are designed to reward companies that invest in innovation. Now, this doesn't just mean lab work or technological breakthroughs. It can include creating new products, improving processes, or even solving technical challenges that are in your industry. If you're a small business, you can claim up to 33% of your eligible R&D costs back, and these costs can include staff wages, materials, software, even subcontractor fees, so quite a lot. Even if your company isn't profitable, you might still be eligible for a cash rebate. The key with this, as with a lot of the others, is keeping detailed records of your projects and your expenses to make the claim process straightforward. And the 9th way you can save money on your tax bill is if your business is VAT registered, choosing the right VAT scheme. One option to consider is the flat rate scheme, as this can save you time as well as money. Here's how it works. So instead of calculating VAT on every transaction, you pay a fixed percentage of your turnover. Now, this is your gross turnover including the VAT. The rate depends on your industry, but is usually lower than the standard 20%. This scheme's ideal if your business has low VATable expenses like a consultancy or service-based business. It simplifies your accounting and could leave you with a little extra in your pocket. But keep in mind, if your expenses are high, the standard VAT scheme might work better. Always review your options carefully. And lastly, number 10 is to keep accurate and detailed records. It seems obvious, but when you track your expenses properly, you can claim every allowable deduction, and that means more money in your pocket. Good record keeping also makes tax filing much smoother. It saves you so much time and stress. An added plus, if HMRC ever audits your business, having well-organised records protects you from potential penalties. You can use bookkeeping software or even a simple spreadsheet, Excel or Google Sheets, for example. And don't forget to save receipts, invoices and mileage logs. You still have to keep that paperwork for 3 years and an additional 4 years for any digital copies. These strategies can make a significant difference in your tax obligations, and it's always advisable to consult with a professional accountant or tax advisor to ensure that you're compliant with the current regulations. Thank you for watching. If you found this information helpful, please consider subscribing for more insights on managing your business finances. Feel free to share your thoughts or questions in the comments below.